DT, good to see you. We're back in the studio.
We are, yes.
Out on the road.
We've come back into the studio. It was it was a good success, I think, the last Out on the Road podcast, but a bit harder work for Alex. Poor Alex was stitching all our bits of kit together. But yes, here we are in the studio.
Yeah, and we've since had the hour change, so it's a lot darker, which is kind of a bit depressing.
And it could get interesting because we're on time lights.
Yeah,
they tend to go click out about 10 minutes in.
Yeah, Alexandra's got to keep moving to keep the. So if you hearing creaking chairs, that's what's happening. Alexandra's keeping the lights on, which is great. And then, of course, we've had the US elections.
We have.
We're recording the day after the confirmation of Donald Trump coming back into the White House. So completely unrelated, we've gone. We thought we'd explore the topic of bank runs.
Yeah, I'm not sure we're trying to, necessarily draw a line from one to the other, but anyway.
No, I think, the reason is, and you know this, Damian, is we got such great feedback from the Lloyd's episode, and what people really enjoyed was kind of going back and looking at things historically and then seeing what can be learnt. And they like the way that we kind of have made that connection. So we thought, well, this is a great one. Let's have a look. And we kind of posed ourselves the question, when and what was the first bank run, and then as we got into it, we found actually that there's been some really interesting ones along the way.
Yeah.
So without further ado, let's just talk quickly about the historical bank runs, and then we'll probably have a run through of really what is a bank run. I know we could start with that.
I thought I'd done quite well by sort of looking back to the sort of Great Depression type era and thinking surely it would kind of be around then. But actually, Nick, you dug very deep and found one a lot before that.
Well, I was very pleased. I mean, I Googled and I found an article that said this is the first bank run. So it was very easy, which was talking about the Peruzzi family in Italy, who were bankers to traders that found themselves between Florence and Venice, and they the bank run came about due to King Edward III, who was the king that took England into the 100 Years' War.
Right. Had to be a war.
With France.
All about war back then.
Well, massive war, and therefore obviously needed a massive amount of financing. Mm-hmm. And with that financing, obviously came the lure of great. He obviously went to the bankers with a business plan and set out why it was going to be so successful. It's going to be great. It's going to be great. Yeah. And so they decided to finance him. And then, unfortunately, when when the battles started to go against him, then he was unable to pay his debts in 1345. And at this point, all of the traders in Florence and Venice knew that the Peruzzis had this big exposure, or were rumoured to have this big exposure to King Edward III, and withdrew their funds, and the Peruzzi Bank failed.
Went under. There you go.
So, that's pretty far back. That's 1345. And I felt so proud of myself, didn't I? Until I found out that actually this had all happened, I think 3 or 4 years earlier, with another Italian bank run by the Bardis.
There you go.
But that's quite good in effect, because that also kind of gives us a little bit of lessons learned. But the same thing, so Edward III was a serial offender, and he was obviously very, very good at going around Italian states looking for financing for his wars.
Well, I assume as he kicked them off, the 100 years bit wasn't factored in particularly. Maybe the first one had been a sort of quick 2-year job, and he gone, well, I can repeat this trade. None of this talk about,
Well, I'm sure there's a few episodes on the rest of his history for people who are really interested into the 100 Years' War. But I think the important thing for our purposes is, here you had a borrower operating between institutions, a serial offender, and defaulting on one, and then managing to get another institution just a few years later to put up financing to him as well. And this was the mistake that was made by the Bardis. And I was very, very pleased with myself. I did find out the amounts involved. So I think with the Peruzzis, they did rein it in. So the King Edward had been lent 900,000 gold florins by the Bardis, and then the Peruzzis went on to lend Edward 600,000 gold florins. So I probably should have done some work on how much a florin
I was
is.
about to say, sounds like it probably is quite a lot of money.
I think it's a lot of money. So those were the sort of the earliest ones, but I think you found a really interesting sort of later significant one.
Yes, that was in Sweden in the 1660s, and actually, as part of the article I found pointed out, it's very much around the time of tulip mania, which, as I'm sure all our listeners will be aware, we have covered in a previous episode. I probably ought to know which number that would be, but yes, that in that period of time, and actually that was all about an institution called Stockholms Banco, and they were one of the first banks. Prior to that, obviously, money had been coins, had been coinage, and they were one of the first banks that took these coins, deposited them, and then wrote bits of paper on top of them. So you started to see the emergence of bank notes.
Yeah, so they're credited with being the first issuers of banknote. I think that's sort of the fame that this bank had. But
yeah, so I think
what went wrong?
So the Swedish government had minted new coins with a lower metal content than the older ones. And this led many of the depositors to demand their heavier, more valuable coins back. And sort of during this process, the bank had gone, well, look, we can offer sort of notes to cover this, to help cover this area. So they carried on printing more and more of these notes, leading to inflation. And actually, what happened was everyone at one point went, hold on a minute, what's the backing behind these notes? And they got called in, as it were, and obviously they were underlying it. There were far more many notes than there were coins, and so that was the sort of first bank run that we saw, at that sort of time.
So that's interesting because that's a bank run that also has the kind of the twist that there's an innovation involved, right? So obviously we have innovations all the time, and that's as an interesting thing to think about when trying to predict, how a bank run might occur in the future and what might bring that about. Obviously we talk about confidence and so on, but it's sort of an interesting thing that an innovation like that, and then an underlying effect, because again I think it was the Swedes decided to lower the content of metal in their coins, and it just made the physical value of what was held by this bank, by the depositors, more in physical terms than actually the face value, if you like, of the coins.
Yes.
So there was a run as a result of that. People were talking about that a few years ago. Do you remember, 5 or 6 years ago, when metal started to really move? There was a question over whether the nickel in coins.
Yeah, I think the 2p was it nickel or copper? I can't remember, but I think I think on the copper move, and this was certainly 10, 15 years ago, it was worth more than the coin itself. So, I mean, it's quite a trade in a way to go and buy millions of these things and deposit them and it will smelt them down, which I'm pretty sure you're not allowed to do, but anyway.
And then we've had some pretty recent ones, haven't we?
We have. Well, I suppose the famous one for us sitting here in the UK would be Northern Rock, which was sort of just, in the lead into the GFC, the financial crisis. 07, 08. And then much more recently, we've seen Silicon Valley Bank, obviously. And I suppose you're talking about innovation. Part of the issue with that, and we'll come on to this later on, is the fact that it was because there were no queues in that one, because it's all...
Well, that's what's so poignant for me about Northern Rock.
Yeah.
Because I was sitting in Asia at the time and seeing these kind of pictures back of the UK, and I remember very vividly the kind of, it must have been a BBC News footage of a lady in her Northern Rock uniform popping her head out of the branch, and there's this queue of people outside of the branch. I've never seen that in my life. And she asked a wonderful question, which was just met with uproarious laughter, which is also kind of odd, given everyone's panicking about their money. But she just put her head out and went, "Does anyone have any money to pay in?" and that was just met with just derision from the crowd.
Yeah.
So the crowd clearly knew what was at play, even if she didn't, working in the bank, which is kind of very interesting. But tell me more about Silicon Valley Bank, because that really is recent. That is like the last 24 months.
Yes, exactly, that's right. Yeah, so that was a bank that was lending to a lot of tech companies out there, entrepreneurs, and what it had done, and I suppose it's in a way ties back to some of the stuff we've talked about in previous episodes, in that sort of that low interest rate environment that we saw that carry on for so long, that was so abnormal, but sort of became, in inverted commas, normal. They got into trouble because they were hedging out a lot of their deposits with longer term treasury notes, and as rates started to go up, the value of those notes started to collapse, and there becomes, even though your notes will be made good at expiry, as it were, there's a big mark to market loss that you're taking as the rates start to rise and the notes themselves start to fall in their face value.
And you're fine while everyone keeps the money.
Exactly, yeah.
Everyone keeps the money in the institution. It's all fine because you don't have to unwind these longer term trades. But when you're forced to unwind...
Yeah, so you're solvent in the long run, but you might not be solvent in the short run. And that's exactly what we saw here, which was there were rumours that they might be in trouble. And these things snowballed incredibly fast. And because, as we alluded to earlier, people can access their bank through an app, people were just withdrawing millions and billions and billions, which they just couldn't cope with because as we sit with these sort of banks that are based on fractional reserve banking, they do not have that amount of liquidity in the short term market to be able to fulfill all those withdrawals. Well,
that's a great. I mean, it is a gallop through some of the historical and poignant cases over the years, and there are so many more, aren't there, Damian? I mean, the Great Depression. There's been certain periods where bank runs have occurred, and it's been as a result of instability. Anyone wanting to look further, then the SKADI Discord is the place to go. There's a lot of detail, a lot of resources for this episode, and certainly you can read much more into the Peruzzis, the Bardis, Stockholms Banco, and so on. If you're interested in a bit of the history and the unusual circumstances, that's all in there in the SKADI Discord. So Let's ask the question, David. So, how would you define a bank run? What is a bank run?
Well, I mean, it's excuse me, a situation where a large number of customers simultaneously look to get their funds out when there are concerns about solvency or the ability of a bank to meet its financial obligations. I mean, it's just that, and it's caused, I suppose, or a direct consequence of the fractional reserve banking the model that now exists out there. So.
So the key word I think is trust.
Correct. Yeah.
So it's when trust goes in the institution, and then people think, "Oh my God, my money isn't safe. I want it back." So that's the sort of the key thing. I would have said before you raised the point about Silicon Valley Bank. I would have also said synonymous was queues, but actually we found that isn't the case.
Yeah.
And that's a really interesting thing going forward. And sorry, you've used this term, fractional reserve banking, now a couple of times in the podcast. What's that?
So that is, the way that a bank will take in deposits from, every man on the street, and then look to lend them out and possibly lend a bigger proportion of those out to, for someone to have a mortgage, for example, whatever it is, on the basis that not everyone is going to claim their money back on the same day. So you are able to multiply the effects of the deposits you've taken to make much bigger loans out into the future.
Yeah, so delving into the history, when I was reading more around the Stockholms Banco situation that you found out about, around the same time, I think it's the goldsmiths that are credited with really realising the potential for this kind of banking, which has effectively become modern banking. So, matching up lenders and borrowers, but then realising, because they were backing up the gold deposits that they held with commercial paper, which people were then trading much more, or they just, again, going back to sort of new product approval committees, when you launch a product and you think how it's going to be used, and then you find out, a couple of years later, actually this is being used in a way that we didn't expect.
Yes, yeah.
I'm always one of my big proponent of revisiting products that have been through MPA just to check they really are working the way you thought they were. And for the goldsmiths, this was a really great thing that they identified, that actually, people were had as much trust. That word trust
Yes,
again
trust was key.
in the commercial paper as they did in with the gold deposits. So they suddenly realised, well, actually, if everyone's got trust in the commercial paper, we can issue more. We can then charge people borrowing rates, and this is how the cycle of credit expansion and money supply grew.
Yeah, so that you work out that you can, you would offer a small interest rate to get people to deposit the gold with you, and then you would issue a piece of paper against that. But then you could lend out at much higher rates, and so you could take the spread between those two rates, and that paper would start to circulate, more and more around the economy, and be used almost as a replacement for the gold actually that sat in the vault.
And the big headache in all of this is time, because those kind of long-term, or the people that are coming to borrow, people are borrowing for big-ticket items, aren't they? That they expect to repay over a period of time. And people are depositing money that they want back at any time, instantly. So you've got this headache, haven't you?
Yes, this mismatch,
mismatch over time, and that's a real issue with all of this. So okay, interesting. And when we think then about we know what a bank run is, how do we prevent bank runs? I mean, I found a really interesting one that really tickled me. Also thinking about the poor lady at Northern Rock. So I was reading that actually during the and I think it's the Great Depression, when you didn't have bank networks, you had one, a bank was a bank.
Yeah.
And you just had that building, and that's where everything was, and you had these individual entities that were banks. If a bank became nervous that customers were, arriving to take their funds out, then the sort of rallying cry would go out to employees and their friends and their families, and they would queue up in front of the bank tellers and conduct just time-wasting small transactions to prevent people from getting to the front of the queue to withdraw their money.
Brilliant.
Because also, reading a lot of the activity by the kind of the central bankers, a lot of the focus is taking the panic out of the situation.
Yes.
And time is a great helper. So there's a lot of the activity is kind of effectively taking over a bank, closing it, and then reopening the next day, but with that time passing and then people having more confidence. But anyway, I thought that was just a sort of a lovely idea of you slowing it down. And the analogy I think with present day is, if you're presented with the technical issues page from your bank, we're doing work.
There's some site maintenance going on, or app maintenance, absolutely, yeah.
Oh, we don't want to spark a bank run by worrying about app maintenance, which happens every weekend at midnight at certain banks. Interesting, yeah. And then I thought an interesting one that I read about was, people just sort of not just saying, well, you just borrow more. But of course, thinking back to Northern Rock and our experience in the global financial crisis, and I remember very much, sitting on the desk, we were looking at, bank CDS rates. You were also looking at kind of what was the talk on LIBOR, what level people were submitting, because you were worried very much about whether your counterparty was going to pay, and kind of counterparty credit and trust. Again, it's that word trust had really gone from the system.
Yeah, Northern Rock had grown so fast because it was a building society that its bread and butter business was mortgages, but it was using the short-term funding markets to facilitate that business, and it was able to roll that long-term debt in the short-term market for years until the credit crunch happened. And in 2007, I think it had a tranche that it was looking to place. And I think that the issue was that I think they were struggling with it, but the rumour started to go around that they were struggling with it, and that was it. That was almost, the key word you say is trust. And once that had gone, the bank run started, even though, as you would normally expect, and what normally happens, and why you have central banks is they step in as that sort of lender of last resort and go, okay, listen, there's obviously a problem here, but we will make good, which is indeed what happened. But the damage had been done. The trust had gone. The queues had formed, and that was that.
Yeah, interesting. And then you've mentioned obviously central banks stepping in and so on. What are the kind of the real schemes, the sort of the big schemes that have come about as a result of kind of trying to prevent bank runs?
Well, we had the two ones that we know, the famous ones really are the US one, the FDIC, and the FSCS in the UK.
So the Financial Services Compensation Scheme.
Yes.
And what's the FDIC, DT?
Federal Deposit Insurance. I'm not sure what the C is.
Go on, I'm going to have a quick... I'm going to look in the SKADI Discord and see what we can find. But anyway, carry on while I'm looking for that. Tell people about that.
So I think the FDIC was set up in 1933, post the Great Depression, and it was interesting to see that the FSCS was actually only set up in 2001 here in the UK. But it says there were other schemes that were sort of there beforehand in the UK.
The Federal Deposit Insurance Corporation.
There you go.
I'm reading your writing in the Discord, Damian. It's terrible you can't remember this stuff.
Well, we're sort of jumping all over the place, allegedly. So yes, 1933 and 2001. So they are, and actually I probably ought to. Yeah. So the UK one I think is £85,000. I think the US one is larger than that off the top of my head. Maybe not into seven figures, but it was a decent size one.
Yeah. So I mean, again, that was one of the things that came out of the global financial crisis back in the days when Nick Corry had some money. I did start thinking about having spreading the amount of money between institutions.
Yeah.
Particularly when if you have something like a house sale, you might sell your house and end up with more than the 85,000, which is entirely possible.
FDIC just looked up is $250,000. But obviously, if you're for instance, looking back at the Silicon Valley Bank issue, a lot of those entrepreneurs would have had far greater deposits there. So the real worry is that the FDIC would cover some, but possibly not much of your net worth that sat within that one institution. But which I think did not help with the run that they saw there as well.
Yeah. So, and then the other sort of going back to that issue of time. And this is again, I'm not sure how robust this is as a strategy, but it is a strategy that liquidity management teams will use. Whatever is term deposits. So the idea of tying up depositors for a period of time. But I don't know about you. Maybe you have encountered a product where you can't actually get your money back until it matures. But the ones I'm familiar with, you get a penalty. You can get your money, but you lose the sort of the preferential interest that you got. Or is that the case? So a time deposit it really is a time.
Yes, I'm not sure. There may be different flavours of it. I mean, I can think of it sort of from the other perspective, which would be a mortgage, which is you can break here in the UK, but there tends to be quite a large penalty to do that. So that would be the sort of reverse of that. I think you're right on the term deposit stuff. You might be able to break it, but you might lose. You might literally just get your amount back, and not including even interest up until that point. So you sort of have to see it through to the final term.
Yeah. Okay, interesting. Well, looking back at the history, what are the think about the lessons from all of these bank runs and where you can learn. When I think it's interesting looking at the Peruzzi and Bardis situation, because that there are some things that are so applicable to today. That's what I love about that. You're talking about 1345, and humans are still making the mistakes, in 2024. So the key one is concentration risk. Both of them had lumped, most of their lending into one massive counterparty, the King of England.
Yeah.
And it was a huge concentration. And so the people that followed, the Medicis, really learned that lesson and, applied diversification. And the other thing too, I think, is a sort of, from a kind of risk management point of view, a very sanguine view of the potential success of King Edward and his warmongering and his exploits, because it's certainly, if you read into some of the history, the criticism is around the speculative nature of the lending to King Edward. They really were in this to try and make a buck, and there wasn't much prudence in what they're doing. So I think that's a kind of the prudential lesson, and then just realizing that two Italian banks made the same mistake over the same counterparty within 3 years of each other, and that is amazing. You'd have to think that they will have heard of it, but anyway. So obviously KYC,
exactly.
Know your customer. Did they know their customer? Had they done their due diligence? And clearly a huge credit risk management failing. Yeah. So that, I think those are the great ones from that. I mean, anything that we can think of from the Stockholms Banco situation there.
I mean, not. I mean, I think it's rinse repeat. Really, it's the same sort of stuff there. I mean, the interesting thing is actually post Stockholms Bank, you actually saw the Swedish central bank was set up in sort of and which is sort of known now to be the world's first central bank. So It was set up to sort of deal with that issue, and it was, I suppose, a lesson learned from that issue. But otherwise, yes, a lot of similar sort of a read across from that bank.
And it is that the idea as central banks, you're just going to really enhance and strengthen the trust, aren't you?
Yeah.
Because there's a huge base from which a central bank to kind of draw in tax receipts and tax money to cover
exactly
the lending of an individual institution, and then Northern Rock. Thinking about that one, I mean that is such a great example, isn't it, of the time, the mismatch, over reliance of
on the short term funding market.
Absolutely.
I suppose yes, it's that sort of looking at a market structure and the assumption that it will always exist in its current form, which is always a dangerous thing to do.
Yeah, and to a certain extent, that's kind of the same with Silicon Valley Bank in a way, isn't it?
Yeah.
They fell into the same trap.
They did, yeah. And I mean, it was. I suppose that was. I mean, there was some interesting stuff. There was some regulatory stuff around Silicon Valley. So a lot of the banks, or some of the large banks, there's a sort of threshold that you become a sort of significant bank within the States, and they were below that threshold. Hence, they had slightly less regulatory pressure on them to do certain things, which was sort of seen as being a failing going forward. That they weren't stress tested as hard as some of the other major big banks out in the States would have been.
Yeah, interesting. Well, I think that's. I mean, it's a bit of a gallop through bank runs. But looking forward, Damian, the big change for me, which I find, love the idea of the queues, and of course, there are no queues.
Yes.
And that sort of just thinking about the kind of the monitoring that an institution can do, because everything's you've got the ability to withdraw in the palm of your hand now.
Yes.
You can just get on with your phone. I never go near a bank branch.
No.
So, and I'm certainly not going to start queuing behind other people's phones. But there is this kind of virtual queue that it's kind of interesting. So I'd have to imagine, and, I'm a convertible bond trader, so I'm not going to hold myself out as some kind of expert on this. But, thinking about it, there has to be a case. So it must, there must be monitoring. You'd like to think there'll be monitoring.
I'm sure there, and yes, there
of the rate at which people are withdrawing.
Yeah,
but also the chatter, right? Because the chatter moves so quickly around, or anything. It doesn't have to be institutions, but any kind of. If you think about the kind of the way that social media can kind of escalate situations as well, there must be some case for monitoring.
Yes, absolutely. Yeah. And which I think people do as part of, general surveillance of, not just your own institution, but other institutions out there. I think that would become part and parcel of what people would.
Well, I think it's certainly something we'd like to know more about. And if, people listening have insights into, that kind of stuff going forward, I think that'd be really. I'd love to know about it, and obviously you can share your thoughts in the Discord, or you can message us on LinkedIn, where we post the podcast as well. I think the other thing too, just as a thought around beyond the idea of the lack of the virtual queue, is again, we think in terms of bank runs, looking and certainly looking back, it's a credit issue. It's whether that bank is credit worthy, and whether my money is safe in that bank. Data is the new oil, or whatever you want to say. I do wonder, and I think I've said this before on the SKADI Podcast, but how soon till we see a bank run or some incident that escalates as a result of a data leak? So people feeling, my God, in this institution, my data isn't safe, and my data is so important to me.
Yeah.
And I wonder if that's an emerging risk as people start to realise how valuable their data is. Because I still think we're moving from a world where people have given away their data pretty readily because they don't really understand.
Yes.
And I think they're only starting to appreciate, just how important and how valuable their data is. And also what can happen to their data, how it can be manipulated and used if it falls into the wrong hands. So I wonder if that's an emerging area to wonder about.
Yeah, I would agree, and I suppose you have started to see, certainly you've seen here in the UK, people attempting to open up to allow data to be sucked in from different institutions into an app to give you an overview of where your finances are. That does increase the risk that there could be a breach somewhere, and then once you've got into one, then you might be able to have move to the other institutions where that data was stored as well. So I think there's a lot to what you say.
Interesting. Well, I've really enjoyed that, Damian. Rattling through the Peruzzi's, the Bardis, Stockholms Banco, and actually SVB, which I before you and I started reading about, I'll be honest, I hadn't really focused much on that situation. I think, kind of rather more overwhelmed by what happened at Credit Suisse than SVB. But I think the SVB case is a really interesting one. And also the fact that it shows you that lessons aren't really learned, and that is the potential for things to come back. Anyway, I think bank run's a great topic on the SKADI Podcast. Hope everyone's enjoyed the episode, and we'll be back soon with a few more looks into finance from a control perspective.
Brilliant. Look forward to it.
Thanks for listening.
Thanks.
You've been listening to the SKADI Podcast, featuring Nic, Corry and Damian Taylor. This podcast is produced by me, Alexandra Mexi. If you found today's episode interesting, you want to be a friend of the show and interact with like-minded people, you should join the SKADI Discord. Our chat community is a big treasure trove of information where you can find all the materials we use to produce our podcasts. If you want to listen to more episodes, then simply search the SKADI Podcast on any streaming platform. Feel free to connect with us at SKADI Limited on LinkedIn to read about our research and business relation to anti-financial crime and control functions. Until next time, thank you for listening.